Hi everyone, welcome back to Mike's Minutes. My name is Mike.dunn, a wealth advisor with IPC Securities. I want to thank you for joining me today. And today I'm going to be talking a little bit about investing in difficult times or going through difficult times while you're investing. Depending on how you look at it, they kind of mean the same thing. So, before I go into to my content today, I want to thank you for joining me. And if you haven't subscribed to my channel, please do so. Not looking for a YouTube career, but it does help with keeping yourself up to date on new content. And I also want to mention that I think the lighting is a bit better this time around. It's a cloudy day outside, so that helps. But I can't remember if I mentioned, but I did get a light that's special for videos. So here we go. Now I don't have to worry about the lighting. But thanks again for joining me. I know we're all going through a very difficult time, and hopefully you learn something new when you watch one of my videos. So, look, like we saw some very interesting things happen over the last 8 months. In my line of work, the markets matter a lot to what we do. Clients are exposed to the markets, and it was very uncomfortable. Markets were down significantly back in March, but skip forward to today and we've recovered quite a bit. Some indices have recovered all and are positive. Some are not quite back to where they were. But from a numbers perspective, things are looking a lot better market wise. I want to highlight something from saying that, the market is one thing, the economy is another. The market looks ahead. The market is a leading indicator. So a lot of investors that have driven markets higher have optimism. And that's why the markets are where they are. We're seeing some really bad economic data, but that's because that's what we've gone through. We're seeing data that's come out and it's a lagging indicator, so it's showing us what happened. The markets are showing us where investors think things are going to be in 2-3 years down the road. So keep that in mind when you're investing. It's not like there's something that you're missing. That's just how markets and economies operate. But when the world shuts down, some countries are back up and running. North America, not so much. We're seeing cases rise, but that's why we really need to make sure that we don't make any rash decisions when it comes to investing. That would be my biggest takeaway from today is don't let your emotions get the best of you. So like if you sold everything back in March and you were waiting for a better time, it's not sure, summer, you start getting busy, whatever happens, and then all of a sudden you've missed this huge run in the markets. So that's why I always recommend we don't try to time the market. Timing the market is very hard, virtually impossible. Well, it is impossible. If I had a crystal ball and I knew exactly where the markets were going, I'd probably have essentially the population of everybody over 18 in the world subscribe. I'd be a very popular individual. And if somebody else could do it, I wouldn't be making a YouTube channel, and you sure as heck would not be watching my YouTube video. So that is the hardest single thing to do when it comes to investing, is timing the bottom and the top. It's impossible. So please, if you try to do it, stop, because it's going to be detrimental, to what you're trying to do long term. So, going back to what I mentioned about emotions, if we let emotions dictate all of our big decisions in life, chances are we make some pretty bad decisions. So if you look back in your life at, sometimes when you're very emotional and you reacted quickly, knowing what you know now, was it the best reaction? Sometimes it takes us a little bit of time to calm down and maybe just to reflect on what's going on, take a deep breath, walk away for 10 minutes, come back, reassess the situation. That's no different than investing. We do not want to let our emotions dictate our actions. My simple analogy is flying. I will use analogies throughout my videos. I've used the flying one and a different one, but I'm very uncomfortable when I fly, but it doesn't stop me from flying. I know a lot of pilots, if they're going through turbulence, they don't all of a sudden change their hundreds, if not thousands of hours in class training or in flight training. They go back to the basics. They ride it out, they calm their passengers down, and look, no plane has ever crashed because they went through turbulence. It's uncomfortable, yes. I'll be the first to admit it's very uncomfortable. But you don't change how you have been trained your whole life to do a particular thing just because you're uncomfortable or just because you're emotional. So, no different than investing. So please try not to let your emotions dictate your actions. And, during times like this, we're working remotely, maybe some more time for news. We're watching more news and we're listening to different opinions of friends. We're probably on the phone more, on FaceTime more. And that adds fuel to the fire because everybody has an opinion. The media, everything we watch, they're trying to sell you the news. So it's not, you don't listen to the news and say, hey, the markets did really well, or companies, they always like to highlight the negative. So when you start surrounding yourself with a lot of negative information, it really makes you emotional and you start thinking about things. And am I doing the right thing? Am I not? I always encourage my clients to reach out to me if they want to have a discussion. If you're feeling a bit emotional about your money, let's have a chat. Let's reassess your situation and make a change if there is a fundamental change with you, not just because you're emotional. So when we invest, we need to look at two main things. First, what is our time horizon? So when do I need money? And second, what is our risk? So risk really means the volatility of ups and downs and the chance of losing money. So if you're higher risk, the chance of your investments going down or the range of your investments going down is a lot higher than if somebody was lower risk. So that being said, when there's volatility on the upside, that means that your portfolio can grow more than somebody who has less risk. So when you look at those two things, like if you have a significant time horizon where you don't need money, you should be able to take on more risk. And if you don't need your money in 20, 25 years, and you saw a significant decrease in the portfolio back in March, why would you sell it? You want to hold on and recover. Those who have less time before they need their money, yes, they might feel the downside just a little bit, or probably not as much as somebody with high risk. And again, unless you need all of your money on a particular day, you have time to recover. So, I know it's not comfortable to see the value of your money go down, but you just don't want to make a rash decision because it's making you emotional. So think of this example. If you could check the value of your house every day, every week, every month, and you saw your house price drop 10 or 15% in, let's say, a month, would you just go out and sell your house? I know you have to live somewhere, so take it with a grain of salt, but it is also an asset, just like an investment portfolio, and they can go down. And if it's a long-term thing, then why would you rush out to immediately sell it? This is where an advisor comes in handy because, we never discuss investments first. It's always, what does money mean to you? What do you want to do with your money? What are your goals, objectives? How much risk do you have? And then something is recommended. So maybe there is something wrong with the risk. You have these conversations. There's nothing wrong with a portfolio that goes down because that's normal. If you don't want any fluctuation in your portfolio, then you buy an interest-bearing investment like a GIC. The rates are awful these days, but if you don't want to see the value go down, then that's something that you should probably invest in. And keep in mind, inflation alone you can lose money buying something like a GIC. If inflation's 2% and you're making 2% on a GIC, you're basically net even. And if it's in a taxable account, you got to pay tax on that 2%. So therefore you lose money. So keep that in mind. It's nice to have some cash on the side for rainy day expenses and, emergencies. But if your long-term strategy with your investments is cash, then I would highly recommend you reassess your situation, because that is risky as well. I don't want to go into so much detail about what you should or shouldn't buy, but basically the moral of this this video is just to take a step back, just like a pilot, and not make any rash decisions. We're gonna get through this. It's uncomfortable, I understand, but that's what advisors are for. We're here to have conversations. We're here to educate. And for those, if you're a client and you're watching and you want to discuss, please reach out. I'm here to help. For those who might be on the sidelines, they're not sure what to do, or they want to make some changes, please reach out. I'm not going to sell you on anything. I just want to educate. So that is really the purpose, like I said, of this channel as well. So I hope everyone has a great rest of their week. We have Halloween coming up, probably the most interesting Halloween we're ever going to see. But get creative, do something different. Maybe not trick-or-treating. Obviously we're not allowed, or I'm 37 years old. I'm not going trick-or-treating, but I'm going to surprise my niece and nephew with a whole bunch of candy. So I'm sorry to my sister and her husband, but hey, it's Halloween. That's what kids love. So, hopefully I didn't give this away, but I don't foresee an 8 and a 9-year-old watching their uncle discuss financial topics on YouTube. So I think I'm safe. But have a great weekend. Happy Halloween, everybody. And until next time, stay safe, stay healthy, and stay invested. Take care.